Forget student loans for a minute. Today, we're dissecting the end of a massive financial liability event. We're talking about the $319.25 million price-fixing settlement that a group of elite American universities just had to pay. And, more importantly, why this whole story is nowhere near finished for the schools that refuse to settle.
That's exactly right. And this deep dive is, well, it's crucial because this isn't just about a big number. It signals a real shift in governance risk for these institutions.
So what are we analyzing today?
We're looking at the class action lawsuit, Henry v. Brown University et al. The case has, brought some resolution for 12 major universities, but it's also confirmed a significant ongoing financial exposure for the 5 defendants still in the fight.
Okay, so our mission today is pretty clear then. We're going to summarize the total financial hit from this settlement. Then we'll get into the alleged misuse of that 568 antitrust exemption and really analyze the overhang for the universities that haven't settled yet. We need to see the full liability picture here.
Let's start with what's been resolved. The total approved settlements in this case have reached almost $320 million.
Almost $320 million.
To be precise, $319.25 million. And that's from agreements with 12 different universities that, decided to mitigate their risk and get out.
And for anyone listening who might have been part of this settlement class, the calendar here is really important.
It is. The fund got a lot bigger recently after settlements were approved back in June and July of 2025. Caltech added $16.75 million, and Johns Hopkins threw in another $18.5 million.
By the key date.
The key date is today, December 27, 2025. This is the absolute final deadline for anyone newly eligible under those Caltech and Johns Hopkins settlements to file a claim. After today, that's it. The book is closed.
All right, let's define the alleged crime that leads to a payout this massive. This wasn't just, a clerical error in the financial aid office. This is an antitrust violation.
Absolutely. The core allegation is that 17 prestigious universities were part of an anti-competitive conspiracy. The lawsuit literally calls it a price-fixing cartel.
A cartel?
Yes. Violating the Sherman Antitrust Act. The claim is that by colluding on financial aid formulas, they gave out less need-based aid than they would have if they were actually competing.
And the result was?
What? The result was an artificially inflated net price of attendance for thousands and thousands of families.
I think it's important to clarify who was actually eligible for this because it wasn't every single student.
No, not at all. The class definition is quite specific. You had to be a U.S. citizen or permanent resident in a full-time undergraduate program. You had to have received some need-based aid.
Okay, some aid.
But, and this is the critical part, the total cost of attendance, so tuition, fees, room, and board, was not fully covered by grants or scholarships. If you paid anything out of pocket or if you had to take out loans to cover a gap, then you fall into this class.
So it's really focused on the students who were allegedly harmed by that under provision of aid. Okay, so that $320 million figure clarifies the scale of the liability. But to really get how these schools ended up here, we have to go back, 30 years, to the law they thought protected them.
Precisely. This all has deep historical roots back in the early 1990s. It started with a 1989 antitrust investigation that led to a Sherman Act suit in 91 against 57 colleges. Most of the Ivy League settled back then, but MIT, interestingly, fought the charges.
And that legal fight led Congress to create this very specific, very narrow exemption they all started using.
That is the critical link. In 1994, Congress passed Section 568 of the Improving America's Schools Act. That created a limited antitrust exemption, and that's what led to the formation of the 568 Presidents Group in 1998.
The consortium.
Right, a group of need-blind institutions. But what's so fascinating is that this very group, the 568 group, it just dissolved. It shut down on November 4, 2022, right in the middle of this lawsuit.
Wow. So that's basically them signaling that the legal ground just crumbled underneath them.
It's hard to read it any other way.
So what did Section 568 actually allow them to do? And how did collaborating on need morph into, allegedly collaborating on price?
Section 568 was supposed to be purely about logistics. It let need-blind schools coordinate on a few things. They could agree to only award aid based on need, use common principles to figure out what that need was, use a common application form.
Okay. Seems reasonable so far.
And they could do a one-time exchange of some pre-award data. But the firewall, the absolute rule, was they could not share any information about an individual student's potential aid award.
So the cooperation was meant to be about fairly assessing a family's ability to pay their wealth.
Not about determining the discount offered.
Right.
Correct. And the lawsuit claims they just blew right past that firewall. Think of it this way. If all your competitors agree on the exact formula to calculate how much a family can pay.
The input.
Right. The input. Doesn't that automatically fix the minimum price that student is going to have to pay? It sets a price floor.
It sets the floor, yeah.
And by coordinating that need analysis so closely, the lawsuit alleges they just eliminated any real competition on financial aid packages. They agreed on rules that reduced the aid, raised the net price, and that's where the liability was created.
Okay, let's switch to the financial mechanics. For our audience, which is really focused on institutional risk, how is this $319 million actually being split up?
The distribution is pro-rata, so it's proportional. And it's calculated based on two things. The net price you were charged by the specific university.
Okay.
And the number of years you attended during the class period. And those periods vary a lot by school, which is really interesting.
What do you mean they vary?
Well, for a school like Johns Hopkins, the alleged liability period was short, just from fall 2021 to early 2024. But for schools like the University of Chicago or Yale, it stretched for 2 decades, from fall 2003 all the way to 2024.
That's a huge difference in the time horizon of this liability. So what does the average person who filed a claim actually get from this?
From the first pot of money, the initial $284 million, the estimate was about $2,600 to $2,750 per person. The new money from Caltech and Johns Hopkins will add a bit more, maybe another $250 on average.
So a few $1,000s.
Yes, but let's put the total payout in context. For these schools with multi-billion-dollar endowments, the gross payment is, absorbable. But this signals a huge governance failure. And the cost of resolution is where the real financial hit is.
You mentioned the cost of resolution. The legal fees on a case this big must have been astronomical.
Staggering. Settlement class counsel was awarded fees totaling, get this, $94,666,666 for litigation expenses.
So nearly $100 million just vanished from the fund before a single claimant saw a dime. Plus another $3.5 million for litigation expenses.
So nearly $100 million just vanished from the fund before a single claimant saw a dime. That's a pretty stark reminder that just avoiding a trial can be almost as costly as the damages. Exactly. For the 12 schools that settled, they paid their price. They've resolved a major financial and reputational risk. They can move on. But the case is far from over. And that brings us to the real investor context here, the litigation overhang.
The case is still active against some very big names. Who's still on the hook?
The litigation is continuing against 5 institutions: Cornell, Georgetown, MIT, Notre Dame, and Penn.
A heavy-hitting list.
For this group, the risk is still incredibly high. And given how much the first 12 paid to get out, any future settlement or judgment against these 5 could be substantially larger. It's a serious financial and governance overhang. The pressure's on.
And beyond the legal risk, I've heard there are, execution risks, problems with the actual payout process.
The administrative side has been a mess. Even though the court approved the first funds back in July 2024, the payments are still pending.
Why? What's the holdup?
All the appeals and claim issues have to be resolved first. And the complexity is just immense. For instance, we saw this incredible issue where the claims administrator software was incorrectly flagging Latin diplomas.
Wait, Latin diploma, you mean like magna cum laude?
Exactly. It flagged them as deficient proof of graduation. That one error forced a full manual re-review of thousands of claims.
That sounds like a technical glitch, but the implication is huge, right?
It suggests, a pretty inadequate level of third-party management, or just how non-standardized the data from these schools is. When you're manually reviewing thousands of claims because of a simple logic error, it just grinds everything to a halt. It delays the final resolution, and the court won't release the money until it's all sorted out. We're looking well into 2026 for disbursements.
Okay, that wraps the analysis. Now for our final segment. And as always, we have to emphasize this is purely for discussion. It is not financial advice. But given the success of this antitrust case against these, traditionally untouchable institutions, what's an outrageous but plausible trade idea that this whole event could spark?
So the underlying premise here is that this case creates much higher scrutiny on all the other opaque financial mechanisms in higher education. That means more litigation risk, more systemic risk in all the adjacent sectors.
Okay, walk us through the structure of the trade.
It's a long-short pair trade, and it targets student financing itself. For the long side, we'd go long U.S. government zero-coupon bonds. We're basically looking at them as the ultimate risk-free asset.
A flight to safety, what's the rationale?
It's a conservative hedge. The thinking is, if this antitrust scrutiny forces colleges to be more transparent and provide more real need-based aid, it could slow down the growth of the private student loan market. This trade is a bet against systemic instability driven by all this new scrutiny on education costs. You just move into the safest asset you can find.
A solid systemic hedge. Okay, so what's the tactical short side? The one focused on the specific liability still in play?
For that, we would short a very focused basket of non-settling university-adjacent real estate, specifically targeting REITs that are focused on campus housing or specialized buildings right next to those 5 schools: Cornell, Georgetown, MIT, Notre Dame, and Penn.
So you're shorting the real estate right on their doorsteps. You're betting on a localized problem based on a legal outcome.
Precisely. A really big loss for these 5 schools, either a huge settlement or an adverse judgment at trial, could trigger a whole negative cycle. First, reputational damage, donor fatigue. That could slow down money coming in. Second, and this is key for the market, the sustained litigation risk could pressure their institutional bond ratings as their endowments face these new unexpected cash demands.
So the real estate is the most direct way to play that localized financial pressure.
It is. We're shorting the local real estate, assuming that all the negative press, the litigation costs, the financial pressure, it's going to dampen local market values.
Right.
It's a direct bet on a financial ripple effect, hitting the physical assets closest to the risk.
That is a fascinating way to link governance risk directly to localized asset prices.
Okay, to recap, we've covered the nearly $320 million resolution, the history of that 568 exemption and its alleged misuse for price fixing, and the massive financial overhang still facing Cornell, Georgetown, MIT, Notre Dame, and Penn. I think the ultimate takeaway here for you is this. The Henry case shows that even these huge, nonprofit educational institutions are not immune to federal antitrust scrutiny. Not at all. It sets a very powerful and very expensive precedent. It challenges cooperative practices in sectors we all thought were protected. From now on, you have to assume that even nonprofit status won't shield you if coordination among peers starts to look like price fixing.
A compelling analysis of precedent to end on. If this level of scrutiny can pierce the shield of a prestigious nonprofit university, what other historically insulated nonprofit groups might be next? That is something for you to mull on.
Indeed. And please remember, everything we discussed today is purely informative. Do your own thorough diligence before making any decisions.